Good day, fellow investors. Time to ask a great question in our overview of the 10 dividend yielding stocks that are on top of the Vanguard High Dividend ETF. And the question was about how to invest in great businesses, as isn't that what Charlie Munger and Warren Buffett have been doing that made the difference? That is completely correct, but even with great businesses, Charlie Munger always adds what is a great business at a fair price. And I looked at these businesses and I'm looking now down the list, all the 400, and I'll try to select the best businesses out there to discuss. And these are all great businesses. P&G, great business, and pharma, etc. However, when it comes to great businesses, how happy am I with a dividend yield of 2%? Is that a fair price or is that an overpriced stock? I think that all of these are currently overpriced, no matter the quality of the business. So to see what is a great business at a fair price, let's look at Coca Cola, which is the great business in Warren Buffett's portfolio that he bought at a fair price, not a bargain price. So he bought Coca Cola 1988, 1989 for $1 billion, I think, and bought 6.2% of the company. And the thesis there, what Charlie Munger was saying to Buffett is that back then the market cap was 16 billion, but to invest, to create that brand value for the same recognition globally, you should invest at least 80 billion. So the brand was what they were investing because that was more valuable than the price on the stock market. So 16 billion was the price, 80 billion was the brand value, how much you would have to spend to have a similar impact that Coca-Cola had back then. And on a fair price, look at where the stock price was when Warren Buffett was buying. So it was a 4x from the early 1980s, and still Warren Buffett didn't shy away from purchasing. And the core was that it was a good company, strong brand, and that it could withstand competition and keep growing no matter what. That was the core of his investment. And if we look at the portfolio now, the position is still there due to buybacks, and they bought, I think, a little bit more later. They are now at 9% of the company. 1.3 billion invested, and now the value is 23 billion. But if we look at the portfolio at the end of 1989, Coca-Cola was, and this is what I like about Buffett, the balls to go into a concentrated portfolio when you have the opportunity that Coca-Cola, Capital Cities later acquired, but you can see here, what is this? 30% of the portfolio. If you look on the spent money, he spent 60% of his money, of his portfolio investment on one company. So when you find that great business at a fair price, you go 60% in, as Warren Buffett did. But what is that? What is a great business at a fair price? What is the fair price? Warren Buffett was paying 14 times earnings, 12 times forward earnings. So not extremely cheap, not a value investing bargain, but yes, a value investment. So 12 to 15 times earnings. And if we look at the summary of what he did compared to the market, he did pay a premium on earnings and cash flows over the average for the sector then. So he paid a premium for the brand. The stock went up, and up, so he didn't shy away from buying more. The stock grew 11% annually, so it did grow even faster than the S&P 500 because of the quality, and it was 91% more expensive than the average S&P 500 stock on the average price earnings ratio. So really expensive from these metrics, not even to mention book value. But Warren Buffett still bought it because he saw that there is growth potential, and that's exactly what happened. What kind of growth potential? So keep in mind, price earnings ratio of 15, let's say that's 7% earnings yield, plus 10% growth. 10 plus 7 is 17%. So he was buying something for a return of 15 to 20%. And that's Warren Buffett's magic. So when you think of a great business at a fair price, you should be able to get it for double-digit returns. And that's a fair price. So let's say 5-6% earnings yield and 10% growth, that's 15%. That's a stellar return. And then again, an example how all businesses, great businesses, sooner or later get to such levels. This is an article that I wrote on Apple. I think it was, yes, March 30, 2016, where it was the Apple's 40-year anniversary. And I said that it is a total bargain for the next 40 years. And you can see the stock was higher than in the past, but it really exploded. And my theory was pretty simple. Back then, the price was around 110 and earnings per share were 9. The market didn't expect growth ahead, but that was unlikely, maybe just pausing for a while in the iPhone cycle. But there was a price earnings ratio of 10, 11, 12, and let's say 5% growth, and that's it. That's 17% returns. Investors since had it even better. So it's always nice to go back to the opportunities. I did buy Apple then as I moved, changed brokers and everything, I sold it. So not holding it unfortunately anymore, but still always an interesting one to analyze. Maybe now it is a little bit overvalued, but Warren Buffett is still buying, and I'm looking forward to next week to see whether he bought more. So a really fair or even great price for a great business is a price earnings ratio of 15 for a company growing 10%. That's already something amazing and will lead to great returns over the long term. The problem is that you really get those few and far in between. Apple here, Coca Cola there, something here. So you have to analyze businesses, watch businesses, and learn about those, and sooner or later you will find them. And then when you find, even if you find it just one a decade, you put in 50% of your wealth and you're set for life. But you have to keep the mindset fresh to do that. And that's exactly what I do. Personally, I follow 50 and more businesses on my research platform. I added 30 now on the public YouTube portfolio that we follow. So subscribe for that. Check what I do. Thanks for watching. Keep in mind, great businesses at a fair price will make you well off long term. See ya.